Hello, hello, welcome back. Amazing panic in the markets today as we are getting sort of like Lehman Brothers vibes. As you'll see here, SVB Financial Group or Silicon Valley Bank pretty much is down more than 60% right now. Obviously, the stock was halted, but it's down significantly. And when it opens, it's going to open at maybe 40 or even less than that. And it's insane because the stock at some point was like $600 a year ago. Again, absolutely insane to see. You can kind of take a look at the 5 years chart, was even more than 500. So an event happened, a pretty important event that could eventually lead to capitulation here in the markets. But what happened? In this video, I'm going to examine and actually help you understand what exactly happened with Silicon Valley Bank and whether this has any potential branches that could potentially arise for other banks as well. So what could happen? Will the stock market crash overall? Will there be more bank runs? Because bank runs and fear are really poison for banks. So what happened here? Silicon Valley Bank fails after run by venture capital customers. And FDIC, the Federal Deposit Insurance Corporation, took control of the bank assets on Friday. And that's obviously really bad. It's almost like bankruptcy here. And the failure raised concerns that other banks could face problems too. So as you'll see here, Silicon Valley Bank kind of ran out of money, which is, as the article points out, an axiom in banking. Don't run out of money. And you will see here that, yeah, it gives us vibes of the 2008 Lehman Brothers financial crisis. And this thing absolutely shocked depositors here. As you'll see later on in this video, we're going to talk about what happened with Silicon Valley and other companies pretty much over there. Now, when something like that happens and the bank pretty much runs out of money, then they basically default and deposits could potentially get lost. So for customers with deposits that are more than $250,000, this is a big problem because till $250,000, you are FDIC insured. So this is why it's generally speaking important to, if you have more than that amount, to kind of divide between different banks. Now, of course, if you have too many millions, it's very difficult to do so, but it's still something that you need to bear in mind, especially when you're going with lesser banks, like less known banks. Now, what happened here is what we're going to examine in more detail because I want us to really understand what caused the Silicon Valley Bank's failure, as you'll see here. So, what happened? Now, we do know that the Federal Reserve has been raising interest rates. Obviously, when interest rates get raised from record low levels even, it becomes tougher for businesses to raise money. It's tougher for technology startups, for example, to get some capital, to draw capital, which are some of the primary clients of Silicon Valley Bank. And this is a big problem here because as you can see here, as higher interest rates cause the market for initial public offerings to shut down, pretty much we're not looking at new IPOs here. Clients who initially didn't really care about this money, they started to face issues there, and they started to pull out money from the bank in order to meet their liquidity needs, right? Because all these companies have liquidity needs, and when they can not really get free capital because capital gets more expensive because of the interest rates, then this is a big problem, and eventually you got a lot of people asking for their money. And so Silicon Valley Bank, who had a ton of these bonds at lower interest rates, they actually had to sell a lot of these bonds. And remember, the correlation between interest rates and bond prices is inverse. So as interest rates go up, then the bond prices go down. The bond prices in the secondary market go down. And the reason why this happens is because now the newer bonds, the bonds that are actually issued now, they give out more interest rates. So the value of the previous bonds that were giving lower interest rates goes down in order to compensate for that. And so when there is a sort of like a bank run and people ask for their money, the bank has to sell because, again, it has to provide the liquidity, and they have to sell at a loss. And so as you'll see here, to fund the redemptions, Silicon Valley Bank sold on Wednesday a 21 billion bond portfolio consisting of mostly of US Treasuries. Now the portfolio was yielding at an average 1.7%, far below the current 10-year Treasury yield, as you'll see here. And so this forced SVB to recognize a $1.8 billion loss, which it needed to fill through a capital raise. And this is obviously a huge problem for the company. Now, they announced on Thursday it would sell 2.25 billion in common equity and preferred convertible stocks to fill its funding hole. And shares obviously started collapsing pretty much and went down 60%. As investors fretted that the deposit withdrawals may push it to raise even more capital, understandably, because when there is a bank run and people get this kind of fear and they start wanting to get more money, the bank doesn't have this kind of cash. The bank is a leveraged institution, and when they leverage themselves out of the lower interest rates, things can go really, really wrong. And this is what happened here for the company, who was initially getting all these bonds at lower interest rates and getting really, really destroyed by that. Now, stock sale collapses. Some SVB clients pulled their money from the bank on the advice of venture capital firms, as you'll see. And this spooked investors. And this is why you are looking at this insane drop in the stock price. And so SVB goes into receivership, as you'll see here, which means that the FDIC actually gets involved here and pretty much shuts it down. And is gonna be taking a look at what is going on with the funds over there. And now it's going to be a huge, huge mess for the depositors, is the big problem. And here's how the second biggest bank collapse in US history happened in just 48 hours. A hysteria caused by VCs. Obviously, what we talked about earlier, venture capitalists here, especially technological venture capitalists, as you can understand, caused this insane collapse over here for the bank. And the roots of SVB's collapse stem from dislocation spread by higher rates, is what I told you earlier. As startup clients withdrew deposits to keep their companies afloat, again, when interest rates are higher, it's tougher to gather money, it's tougher to get money, so you have to sell. You have to withdraw deposits pretty much in this case. And the company, the bank has to sell because it doesn't have these deposits. So they have to sell their older bonds that are now worth much less because the newer ones have higher interest rates, they pay more, and so they're worth higher than the older ones. It's a big problem. And so SVB found itself short on capital. And this is what happened here. So I wanted to tell you exactly what happened here so that you understand the exact reasons why this has happened here. And of course, it's going to have a lot of problems for a lot of tons of companies, especially smaller companies around the area and pretty much everywhere where they were actually getting deposits from. Now, shut down by regulators in biggest bank failure since global financial crisis. And once again, what I told you earlier, the FDIC Standard Insurance covers up to $250,000 per depositor, which for some companies is basically nothing. And this is going to be huge for a lot of the big businesses there. And as you'll see here, according to press releases from regulators, the California Department of Financial Protection closed SVB and named the FDIC as the receiver, pretty much. And they have in turn created the Deposit Insurance National Bank of Santa Clara, which now holds the insured deposits from SVB. And it's going to be a huge, huge mess, understandably. So big problems here for the company. And I'm pretty sure the stock price will keep on falling. And I don't anticipate that this is going to be having a closure soon, anytime soon. There's going to be a lot of action going on here. And obviously, we're going to be covering it in this channel as we learn more about it. Now, investors and founders express shock, obviously, and describe struggles to get money out. I thought this article here from CNBC was very interesting because it actually has some pretty much quotes from people that tried to take money out and they couldn't. As you'll see here, what message, once tech CEO was sympathetic, what message would even reassure you that your money is safe when other people are telling you that there is fraud happening? There's no message over here is what they're saying. A Twitter-led bank run because all these events were actually propagated by Twitter, but you could say that it's Twitter-led, this kind of bank run, because, social media, very, very important, can cause fear. But it all stems from the fact that the bank, the company, made their own action, took their own actions in its older days, and this is why they are suffering right now. And yeah, obviously they didn't expect this kind of interest rates that we have nowadays, and this is a problem, and took a lot of leverage, frankly. A lot of people live down to the dollar in terms of budgeting, and they cannot afford 24-hour delay in their payroll, which is going to be the least of their worries right now, as you can understand. We found out this morning that no one got paid. Huge issues here. We started to manually pay our warehouse employees because we didn't have to manually send payments to everyone. Big problems, as you can understand. This really affects companies. It's a huge deal, frankly. It's a really huge deal. Later on Friday, one of the startups investors called Young and offered to help Kita make payrolls. He said, "My hope is that the government bails out people past $250,000." And yeah, this is where all hell breaks loose here. The government is going to be having a pretty hot potato here in their hands. I don't know what they're going to be doing, but they don't have to do that. More than likely they won't, and if they do, it's going to be tax dollars pretty much. So it's going to be taken out of people's taxes eventually. I know people with tens of millions, hundreds of millions with SVB, understandably, and one case of that sort is one case that was brought to my attention by one of our esteemed Discord members. Roku says 26% of its cash reserves are stuck in Silicon Valley Bank. Huge problem, around 487 million. Insane, or 26%, imagine that, 26% of Roku's cash reserves are stuck there. 487, almost $500 million, and they're getting like $250,000 out of it. Of course, they could get a little bit more once the clearance happens, but there's gonna be a ton of anxiety over here, ton of anxiety, and obviously shares have tumbled as well after hours for Roku because if this is the case, a lot of money in their coffers could potentially disappear. So huge troubles here. Yeah, this is a very big event. It's going to play a role in the stock market in the next few weeks, I'm pretty sure. So this is going to be a time where we're going to be examining companies for the long term, obviously. And we need to be a little bit patient here, wait it out, see how this plays out. But also keep in mind that this could leave us with fantastic opportunities, even cheaper prices, with the stock market potentially even crashing and having even a black swan event, who knows. So we're going to be watching out for what happens, but thank you for watching this video. Remember to leave a like and subscribe if this helped you understand what's happening right now with Silicon Valley Bank. And thank you for watching, guys. I'll see you soon, and of course I'll let you know if anything new happens. Bye-bye.